TSMC slid 0.7%. The lab scores at 61, a clear buy. While macro jitters cause minor fluctuations, the tech giant controls over 90% of the world's advanced semiconductor manufacturing. Their monopoly on sub-3 nanometer lithography represents an unyielding physical reality that competitors simply cannot replicate. Our full teardown reveals how this hardware moat guarantees massive margin expansion. TSMC sits as a Tier 1 bottleneck in the AI supply chain, the foundry layer currently in a peak phase. Capital World investors just increased their stake in Taiwan Semiconductor by 20%. They now hold 0.6% of the company. That represents a $420 million institutional bet. This massive accumulation is the real signal. The retail market sees a 0.66% slip to $13.52. They misinterpret this minor pullback as weakness. While the broader indices flatline, smart money is quietly positioning. They are preparing for a massive hardware-driven re-rating. Wall Street is pricing in a temporary consolidation phase. The stock rests just below its 20-day moving average of $13.74. But what the general market misses is the momentum of this capital rotation. Investors are fleeing speculative, unmonetized software plays. They are dumping capital directly into the physical toll booth of the digital age. You cannot run artificial intelligence on promises. You run it on silicon. Taiwan Semiconductor sits at the absolute center of this structural shift. They will capture the lion's share of global infrastructure spending. Meanwhile, software valuations will continue to compress. This is not a simple momentum trade. It is a fundamental reallocation of capital. The market is pricing in a future where hardware is the only viable moat left in tech. The physical constraint that dictates Taiwan Semiconductor's dominance is the packaging yield of CoWoS, chip-on-wafer-on-substrate, with local silicon interconnects, an advanced packaging technology that allows multiple active dies to be integrated on a single substrate. To build NVIDIA's Blackwell architecture, TSMC must achieve a packaging yield of over 90% on a massive reticle size. This reticle combines 2 logic dies with 8 HBM3E high-bandwidth memory, a stacked DRAM technology that delivers over 5 terabytes per second of memory bandwidth. Wall Street models assume infinite capacity. The physical reality is limited by ASML's high-NA EUV, high numerical aperture extreme ultraviolet lithography, the next-generation chip-making tool that uses a larger lens design to print features smaller than 2 nanometers. TSMC is transitioning from N3B, TSMC's first-generation 3-nanometer process node that utilizes extreme ultraviolet lithography, to N3E, TSMC's enhanced 3-nanometer node designed to improve manufacturing yields and lower production costs. Quarterly financials showing modest revenue momentum for TSMC. By Q4 2026, escalating global tariff uncertainty will compress TSMC's operating margins by 150 basis points. Basis points, hundredths of a percentage point, measure changes in financial yields and margins. The macroeconomic ocean is shifting. The Federal Reserve holds rates at 3.63% to fight persistent inflation. Meanwhile, the yield spread, the difference in interest rates between different debt instruments, is normalizing at plus 0.38%. This normalization signals a stabilizing macro backdrop. Recession risk, the probability of economic contraction, sits at just 7.1%. Yet, TSMC faces a unique monetary squeeze. CPI, Consumer Price Index, which measures the average change over time in prices paid by consumers, is 0.6% YoY. This low domestic inflation contrasts with rising global capital costs. With the 10-year yield at 4.54%, borrowing to fund massive capital expenditures is increasingly expensive. The market acts as a wave. It carries some companies forward while dragging others down. For TSMC, this wave is highly turbulent. Smart money is transitioning from early accumulation to peak ownership. Institutional funds like Vanguard and BlackRock are adjusting their portfolios. They are pricing in CHIPS Act, the U.S. federal statute allocating billions to domestic semiconductor manufacturing subsidies. Yet, they are doing so with extreme caution. Political friction threatens to capsize this progress. Trade war fears over Greenland and new tariff threats loom. Tariffs represent a massive headwind. A proposed universal tariff could hit electronic components. Export controls, government restrictions on shipping sensitive technologies to specific nations, threaten TSMC's revenue. China exposure remains a critical vulnerability. This regulatory friction acts as a massive undertow against TSMC's 35.1% revenue growth. The capital rotation is clear. Capital is flowing directly to physical bottlenecks. TSMC sits at the absolute center of this flow. Yet, the cost of regulatory compliance is rising. Every new fab built outside Taiwan dilutes their capital efficiency. The macroeconomic environment is no longer just a backdrop. It is an active threat to TSMC's high-margin fortress. They must build expensive fabs in Arizona, Germany, and Japan. These geopolitical hedges erode their core pricing power. The era of cheap, centralized manufacturing is over. Now, TSMC must pay the price of global fragmentation. Geopolitics is the ultimate force shaping TSMC's destiny. The company is the epicenter of the global technology supply chain. Over 90% of advanced logic chips originate in Taiwan. This concentration creates an unprecedented single point of failure. To mitigate this, TSMC is building overseas. They are expanding in Arizona, Japan, and Germany. But these regional fabs come with a massive premium. Operating costs in Arizona are significantly higher than in Taiwan. Labor dynamics present a severe bottleneck. Cultural clashes and labor shortages plague the Arizona construction sites. Meanwhile, back home, TSMC faces rising domestic costs. Taiwan's electricity tariffs are climbing rapidly. This directly impacts the power-hungry EUV, extreme ultraviolet lithography, the light-based printing technology used to etch microscopic circuits onto silicon machines. At the same time, the packaging bottleneck tightens. Demand for CoWS, chip-on-wafer-on-substrate, the advanced packaging technology that stacks multiple dies, is insatiable. TSMC is accelerating CoWS development. They are leveraging FOPLP, fan-out panel-level packaging, which processes chips on large rectangular glass panels, to expand capacity. Yet, the geopolitical tightrope is fraying. The US-China tech war is accelerating. Export controls restrict shipping advanced AI chips to China. This directly threatens TSMC's revenue from Chinese customers. Any military escalation in the Taiwan Strait would instantly halt global electronics assembly. This tail risk is completely unpriced by Wall Street. Socially, public backlash against big tech is mounting. Governments are scrutinizing the concentration of AI power. This political pressure threatens TSMC's largest hyperscaler customers. If AI regulation cools capital spending, TSMC's leading indicator revenues will fall. Furthermore, public backlash against energy consumption is growing. AI data centers demand immense power. TSMC's manufacturing process is incredibly energy-intensive. As governments mandate greener operations, TSMC's compliance costs will surge. The market wave is currently at its peak. Capital is flowing aggressively into hardware infrastructure. But waves always break. The structural costs of geographic diversification will eventually catch up. TSMC is the ultimate toll booth of the digital age. But maintaining that toll booth is becoming unsustainably expensive. The physical reality of geography cannot be ignored. Geopolitical friction will inevitably erode the monopoly. TSMC reported earnings per share of $22.08, beating the Wall Street estimate of $21.14 by 4.4%. A solid beat that signals strong execution. We see TSMC delivered 4 consecutive earnings beats. Q2 26 plus 4.4%, Q4 25 plus 5.2%, Q3 25 plus 8.0%, and Q2 25 plus 3.7%, averaging a 5.3% surprise. The beat magnitude is shrinking each quarter, indicating management is sandbagging its guidance. Yet the stock sits at $13.52 with a consensus target of $15.28, a modest 13% upside. showing the market is rewarding these beats less over time. TSMC, Foundry, is trading below its 20-day average at 13. Part A management's headline: structural pricing power and unmatched technology leadership. Those 6 words appear in every prepared statement, every investor deck, and every Bloomberg interview. They are designed to make you feel 2 things: security and inevitability. Security: TSM is the toll booth of the digital age, and no one can build a road around it. Inevitability: every AI token, every smartphone, every data center rack will keep paying TSM's invisible royalty. What they are designed to make you not think about: the cost of keeping that toll booth open. Let's decode the language. When management says structural pricing power, they mean they can raise wafer prices 5 to 7% every year without losing a single customer. That is true, until it isn't. The last time TSM tried a 10% price hike on N3 wafers, NVIDIA pushed back with a 12-month volume commitment in exchange for a 3% cap. The press release called it customer cooperation. The 10Q called it margin pressure from cost-sharing agreements. That's the gap. Now look at the insider activity. Over the past 90 days, insiders net sold 192,699 shares. That's not a rounding error. It's the entire C-suite trimming. The pattern? Every time TSM stock rallies 25% in 6 months, the insiders sell. They sold after the 2023 AI upgrade cycle. They sold after the 2024 Blackwell ramp, and they're selling now. Historically, this precedes a 12 to 18-month period of flat or declining margins. The message isn't we're bearish. The message is we're monetizing the narrative while the street still believes it. The official narrative also leans hard on unmatched technology leadership. That phrase is code for we're the only ones who can print 3 nanometers at scale. True, but here's what they don't say. The 2 nanometers node is slipping. The backside power delivery integration is running 6 months behind internal targets. Every time an executive mentions yield improvement, listen for the hedge, on track for high volume production in 2026. That's not a date. That's a prayer. And then there's the elephant in the room, Arizona. Management calls it strategic diversification. The 10Q calls it a $40 billion depreciation anchor with 30% higher operating costs. The press release says customer cooperation in cost sharing. The 10Q says customers are reluctant to commit to long-term volume agreements at premium pricing. That's not cooperation. That's a standoff. What management is saying is, trust us, we're indispensable. What the lab hears is, we're monetizing the bottleneck while it lasts. Part B, let's talk about the smart money thesis. The accumulating funds see something retail hasn't priced in yet. TSM isn't just a foundry. It's a packaging monopoly. CoWoS capacity is the real bottleneck, and TSM controls 95% of it. Every time NVIDIA ships a Blackwell GPU, TSM gets paid twice. Once for the wafer, once for the interposer. That's why Capital World investors added 20% to its position. They're not betting on smartphones. They're betting on AI rack density doubling every 18 months, and TSM being the only shop that can keep up. But here's the divergence. Retail sentiment on StockTwits is 92% bullish, with takes like, AI can't survive without TSM. The smart money isn't betting on survival. They're betting on margin compression. R&D as a percentage of revenue is up 20.7% YOY, but the R&D line item is growing faster than revenue. That's not efficiency. That's desperation to keep the lead. And when R&D outpaces revenue, margins eventually follow. Now look at the EPS signal. For straight quarters of beats, average surprise plus 5.3%. The street cheers. The lab asks, what's the trend? The last 2 beats came from packaging revenue, not wafer pricing. That's a shift. Wafer pricing is inelastic. Packaging pricing is negotiable. And when your biggest customer is NVIDIA, who just launched its own in-house packaging R&D, every packaging dollar is a dollar at risk. Wall Street positioning tells the real story. BofA just raised its price target to $590. ARK trimmed its position. That's the tell. Analysts keep raising targets because they're paid to cheer. ARK trims because they're paid to win. and the bid is thinning. Short volume is in line with baseline, but the short cohort isn't the story. The absence of a short squeeze is. When a stock rallies 450% in 4 years and the short interest doesn't spike, it means the bears have given up. That's not bullish. That's complacency. Now let's apply the maverick lens to the 10Q risk factors. The phrase geopolitical instability in Taiwan appeared once. It appears 3 times, and for the first time, it's paired with potential disruption to global supply chains. That's not boilerplate. That's a red flag. Management is signaling that the risk is no longer theoretical. It's operational. The final PR verdict. TSM's narrative is a masterclass in misdirection. They want you to focus on the wafer. The smart money is focused on the packaging. They want you to focus on the node. The 10Q is focused on the geopolitical fault line. And the insiders? They're focused on the exit. Watch for this in the next 10Q. CoWei's capacity utilization drops below 90%. If that happens, the thesis changes. Because when the packaging bottleneck breaks, the royalty stops. And TSM stock isn't priced for a world where it's just another foundry. It's priced for a world where it's the only one. Wall Street zeroes in on the consensus price target of $15.28, forecasting a 13% upside. The lab watches the MACD histogram, now at -0.0862, as the true momentum driver. The gap between a bullish target and weakening momentum is where the trade lives. The momentum breakdown for TSMC. RSI sits at 42, pointing to neutral zone, waiting for a clear directional signal. MACD is currently bearish, with downward histogram pressure. The bull case for Taiwan Semiconductor Manufacturing Company is anchored in an unyielding physical reality. They own the only high-volume printing presses for microscopic logic on Earth. Specifically, TSMC is leveraging its transition from the N3E, the 3-nanometer enhanced FinFET, Fin Field Effect Transistor, a 3-dimensional transistor design built on a substrate process node, to the upcoming N2, the 2-nanometer nanosheet transistor architecture featuring backside power delivery, which routes power from the rear of the silicon wafer to eliminate routing congestion. This transition, combined with the aggressive ramp of CoWESL, chip-on-wafer-on-substrate with local silicon interconnects, the advanced packaging technology that stacks multiple silicon dies on a single substrate to bypass physical reticle limits, gives TSMC unprecedented pricing power. They are charging premium prices exceeding $20,000 per N3 wafer, forcing hyperscalers, massive cloud service providers, to absorb these costs because there is simply no other foundry, a factory where microchips are manufactured, capable of matching their yields. This packaging bottleneck means every single generative artificial intelligence accelerator, from the NVIDIA Blackwell B200 platform to AMD's Instinct MI325X, must pass through TSMC's packaging lines. This structural monopoly guarantees high capacity utilization and premium margins through 2026, shielding the company from the commoditization occurring at the software layer of the technology stack. But here is what breaks the bull thesis. The massive, unhedged depreciation costs of overseas expansion are about to collide with TSMC's structural margins. While Wall Street celebrates the $6.6 billion CHIPS Act, the U.S. government subsidy program designed to onshore semiconductor manufacturing for the Arizona Fab 21, the reality is that these overseas facilities operate at significantly higher cost structures than Taiwan. Management targets a long-term gross margin, the percentage of revenue remaining after subtracting direct manufacturing costs, of 53%, but this is highly vulnerable to rising electricity tariffs in Taiwan and the lower yields of early-stage U.S. packaging lines. The smart money is already showing signs of hesitation. While Capital World investors added 20% to their position, Sanders Capital trimmed their holding by 12%. Furthermore, the options market is flashing a clear warning signal with a put-to-call ratio of 1.25, showing that institutional traders are actively hedging against a near-term pullback. The technical setup supports this caution, with the stock trading at $13.52, sitting below its 20-day moving average of $13.74, showing an RSI, Relative Strength Index, a momentum oscillator that measures the speed and change of price movements, of 42.3, and exhibiting bearish momentum on the MACD, moving average convergence divergence, a trend-following momentum indicator that tracks the relationship between two moving averages. This divergence raises a critical question that cuts to the core of TSMC's corporate strategy. How does management plan to protect margins as expensive overseas capacity comes online? And when does their packaging monopoly face a real threat? Management uses the phrase customer cooperation and cost sharing to mask the friction they are experiencing with hyperscalers over overseas pricing. In reality, this language signals that Apple and NVIDIA are pushing back hard against paying a premium for chips fabricated in Arizona. The lab's analysis indicates that this bottleneck will not break until at least 2026, when Intel's 18A, Intel's 1.8 nanometer class process node featuring ribbon FET transistors, reaches true commercial scale, or Samsung achieves stable yields on its 3 nanometer gate-all-around process. Until then, TSMC has a free hand to pass costs forward. However, the corporate narrative glosses over the fact that advanced packaging capacity like CoWoS remains the absolute gatekeeper of global AI GPU shipments. If TSMC cannot scale its packaging yields fast enough, hyperscalers will delay their capital deployment, leaving TSMC's expensive N3 wafer lines underutilized. The lab's verdict is clear. If TSMC successfully scales CoWoS capacity to resolve the Blackwell packaging bottleneck by Q4 2026, the stock is highly likely to break past its resistance level of $14.88 and march toward the street consensus price target of $633.33, driven by explosive high-performance computing revenue. Conversely, if geopolitical tensions escalate or further U.S. export controls on sub-7nm silicon completely sever shipments of high-performance AI chips to Chinese customers, the stock will fall back to key support at $13.12, or even test the deeper chart support level of $409 as legacy node underutilization drags down margins. The lab's conviction, reflected in our AI score of 61 out of 100, lies with the primary scaling scenario, because the physical dependency of the entire global AI infrastructure on TSMC's advanced packaging makes them the ultimate toll booth of the digital age, a bottleneck that no competitor can realistically bypass before 2026. Here's the macro picture shaping TSMC. U.S. export controls on advanced sub-7nm silicon directly restrict TSMC from shipping high-performance AI chips, like the NVIDIA H200 to Chinese customers, forcing a heavy reliance on U.S.-approved export variants. Meanwhile, the $6.6 billion CHIPS Act subsidy for TSMC's Arizona Fab 21 accelerates the geographic diversification of Apple's A-series processor supply chain away from the Taiwan Strait geopolitical choke point. The massive demand for generative AI accelerators is driving TSMC's rapid transition from N3E to N2 nodes, while pushing CoWoS advanced packaging capacity to its absolute limits. This packaging bottleneck directly constrains the production of next-generation hardware, like the NVIDIA Blackwell B200 platform and AMD's Instinct MI325X accelerators. The primary near-term upside catalyst is the rapid margin expansion from N3B and N3E yield improvements as Apple ramps up 3 nanometers silicon production for its upcoming device refreshes. Conversely, the biggest downside risk is a sudden macroeconomic slowdown that dampens global smartphone demand, leading to severe underutilization of TSMC's mature legacy nodes. TSM trails its peers on revenue growth, delivering a 35.1% increase versus Samsung's 69.2% top rate. Intel's single advantage over TSM is its explosive YTD performance, up 140.8%, while TSM's share sits at $13.52 with no disclosed YTD gain. Samsung eclipses TSM on gross margin, posting 48% versus TSM's undisclosed figure, and also outpaces every rival on growth speed. Global Foundries only beats TSM on price to earnings, sitting at 49. TSM's 61-point buy rating signals a clear upside catalyst for investors. What's the one number from TSM teardown that surprised you most? Comment below. All views expressed are for educational purposes only. We're not offering financial advice. Please conduct your own due diligence. And remember that past performance does not guarantee future results. Investing involves risk, and you should assess your personal financial situation before acting on any recommendation. Subscribe now for deeper semiconductor insights you won't find elsewhere. If you want our full breakdown on NVIDIA, the link is in the description. Stay sharp, keep engineering your portfolio.